Hello and welcome back to Equity, TechCrunch's venture capital focused podcast, where we unpack the numbers behind the headlines. I am Alex Wilhelm, and joining me today is Danny Crichton, a longtime member of the Equity family. Danny, how the hell are you?
I'm doing all right, Alex. How are you?
I'm good, but I wanted to pause, if it's okay with you, and talk a little bit about yourself. I know that if I asked you to tell everyone about yourself, you would just give us like a joke. So I did some research on you. Sorry about that. And I'm going to run through your personal bio in like 15 seconds so everyone knows where you're coming from and kind of what you're bringing to the microphone, as it were. So first, you had a short stint at Google after your time at Stanford. You were whatever the hell a Fulbright visiting researcher is in South Korea. You were at General Catalyst, the VC firm, for a bit. You did the baller move of going to Harvard and then dropping the hell out, which I think is pretty good. You did stuff at TC for a while, then you abandoned us and went to go work for Charles River Ventures, or CRV, built some stuff on your own, came back to TC, helped launch TechCrunch, and now you're the managing editor of TC, which is cool, but I have to ask, what does a managing editor do?
A managing editor does not write.
How'd you get that job?
I acquired it and was rewarded by not being able to do the job that I want to do.
No, that's not true. Well, anyways, we're glad that you're back. You've been on the show, what, a half dozen times, 10 times?
Something like that.
Yeah, good. Well, you'll be around every week for a good chunk of time, which has us all at Twitter and all very, very excited. And just so everyone knows, we're getting 2020 in shape. We all know we just lost Kate Clark, who was the co-host for a long time. We miss her already. Bon voyage, Kate. But we're getting the guest list in place. We have the new Equity Monday short forms coming out. We're tinkering with my audio and acoustic setup, so lots of good stuff coming up. But I think that's enough throat clearing. Shall we dig in?
Let's go.
All right. Starting off today with some quick hits from the early stage market. I'm going to go first. I wrote about a cool startup that just raised a Series A. Danny, have you heard of Lily AI?
I read your story this morning, Alex.
Okay, let me try again. Before you read my story this morning, had you heard of Lily AI?
I have not, Alex.
Your enthusiasm.
That was the best segue we've ever done on this show.
I'll give it like bottom decile. Anyways, Lily AI, I also hadn't heard of them, which is why I asked that. But their new investor is someone that I do know, Maha Ibrahim. She's fantastic. She's over at Canaan. She came on, actually going way back in time, my old TC show Bullish back in the day. Anyways, it's a really cool company. It's founded by a couple of women, one formerly of Box, one formerly of UNICEF. And they've put together a company that does something that I didn't know people needed. And I'll try to explain it to you. So if you had to click a deep learning algorithm and have it look at like clothing items, like pictures of them, you can pull out attributes pretty easily. 1, 2, 3. They pull out a bunch, and then they kind of correlate that with information on individual people, and then help brands and e-commerce stores better recommend stuff for you. And it's pretty cool. And the reason why it's worth talking about, I think, is that the technology has already shown pretty strong improvements to like the sales, sales results of a lot of these stores. And so they're kind of coming into the Series A. It feels a bit more mature than a lot of Series A companies that we see. And I'm stoked about it. But I don't know, Danny, how close do you track the kind of e-commerce world?
As someone who has worn the same Oxford button-down shirt since around 6th grade, I would tell you that fashion tech is probably not one of my strongest suits.
You know, I don't think it's fashion tech, though. You're the second person to say that today. I think this is e-commerce tech applied to the world of attire. And I think if you call it fashion tech, people are going to presume it's kind of like niche-y and not very important. But like e-commerce, which I think this should have kind of applied to more broadly in time, is like, trillions of dollars. So it's big, Anyways, 12.5 million Series A. It only raised a couple million before. Canaan now on board. NEA is also in the round. And that's Lily AI. I think it's a cool story, and I'm excited to see what's up for them next. But you have some short forms as well, so what's up?
Yeah, a couple of good pieces of news before we get to the bad parts of the Equity podcast today. One great exit that I think kind of got bulldozed this week, Armis Security, an AI, they're all AI-driven security companies, but an AI-driven security company was acquired by Insight Partners for $1.1 billion this Monday. And it's a sort of a classic kind of SaaS enterprise buyout play. We've seen a lot of this from a couple of different firms, but it's a reminder that in this space, there are still a lot of exits in the unicorn space, and it seems to be doing really well. One interesting company out of Boston, Waltham, Boston in particular, Vecna Robotics, is a creator of self-driving forklifts If this doesn't scare the crap out of you, I don't know what else will. But in a lot of warehouses, of course, you have forklifts. You have a lot of people walking around, and sort of the holy grail of all warehouse startups is to be able to have humans and machines working collaboratively in the same place, lowering the cost of operating a warehouse, being able to deliver goods, pick and pack, all that. Vecna's at the core of that, and they raised $50 million from a firm I haven't heard of called Blackthorn Ventures. So that's a really interesting one. They're formerly funded by Highland Capital, Fontanalis, and Drive Capital. And then third, in the good news department,
actually, can we pause and just talk about that for 1 second? Have you ever driven a forklift?
I have not.
It's one of the things that I haven't driven, but I really want to. I was hoping you had, because I've done some farm work and some stuff in warehouses, but I've never gone to drive a forklift because the operators are so specialized in what they do. And often they're very impressive. Like, good forklift drivers are like artists, and they can do really impressive things with pallets and moving around. So if there's a way to automate that, on one hand, I'm kind of bummed because the people that drive forklifts kick ass at it, and they're really cool to watch. But also, like, it implies a really high level of precision. It isn't just like and moving around really jerkily. This is often stuff that needs to be relatively fluid, and that's why it's cool to me. It's not just another robot arm. This is a thing that's going to be moving heavy objects in crowded spaces. Needs to be very precise. Needs to never make mistakes. I mean, it's actually a relatively hard problem. And that's why it's cool. Anyways, keep going.
Well, I was going to say, we at our mobility event earlier last year at TechCrunch, we had the head of Playground Global, which is a robotics-focused VC firm. And one of the major theses that they have is how to get all self-driving automobiles, forklifts, let's add everything that might be mobile, to interact with each other, right? And so I think on the floor of a warehouse is a great example of this. Humans are walking around, forklifts are going left and right. No one needs to die. And that's the biggest challenge there. So it's all interactivity. And then also there's a ton of startups in the location, particularly internal location space. So in the warehouse, where exactly are these forklifts down to the centimeter, right? What direction are they facing? You can't use GPS in most of those contexts. So there's a bunch of beacons and homing companies focusing in on that.
Exactly. But before we jump into the big stories, I cut you off. Let's talk about HighRadius really quickly.
Yeah. So one more, a great example of a company completely outside of the major kind of ecosystem zones, but this is a Houston-based company called HighRadius, which does AI-powered fintech software. So clearly AI, everything's an AI company these days, but has raised a $125 million Series B growth round from Iconic, and is sort of a classic example of, maybe it's a little bit surprising coming out of Houston, but it is a good example of where enterprise and SaaS is now a global phenomenon. Everyone outside of Silicon Valley, New York, you don't need to have this expertise in 2 or 3 cities. In places like we've seen the first kind of billion-dollar company out of Cincinnati. We've seen this out of Houston. And it's great to see that startups are percolating in more and more places all across the nation or all across the world.
Yeah, and this is a story that was on Crunchbase News, My Old Home, if you will. I think it was written by Marianne Azevedo, who's kept a really close eye on kind of the Austin, Houston, Dallas trio of cities. And what I've learned by watching her work is that there's so much more going on than what I thought there was when I was living in San Francisco. And I said to point out my own myopia. Because there was so much going on within a 10-block radius, you never have to kind of go looking for anything to have, just to get a full fill. But this is the kind of story that she's really bringing to the fore, and I want to give her points for it. Okay, now we're going to talk about SoftBank, and it's been a week.
It's been a real week.
Yeah. I'm trying to figure out where I want to begin. Why don't we talk about
food? So let's talk about pizza. I mean, everyone's favorite food. Apparently not everyone's favorite food, because somehow delivering food and delivering everyone's favorite food is not a profitable business.
It wasn't a business at all, question here. And we're talking about Zoom, which is Z-U-M-E, not Zoom, the Microsoft device, not Zoom, the video conferencing software we're currently using, but Zoom, the robotic pizza delivery company. Now, Danny, when you heard that SoftBank's vision fund had put several $100 million into Zoom originally, what was your first gut reaction?
Well, in some ways, it's a smart play, right? So pizza is by far the largest delivery market in the United States. There's almost nothing else that comes close to it. So in some ways, you're like, if you're going to do food delivery, you might as well just do pizza, because pizza is something like, I think it's even a majority of the market of all food delivered to all homes in the United States. So it makes sense. And then robotics, the idea was sort of, there's a bunch of these sort of take and bake pizza joints all around the country. The idea with Zoom was like, hey, you can flash heat this right in front of the home. It's piping hot. You don't have to use preservatives. You don't have to use all that dusting that you see in the pizza boxes in order to lower the moisturizing. The problem is somehow that doesn't all work out because the boxes are really expensive, the pizza is really expensive, the cars are expensive, licensing is expensive. You can't just drop pizzas wherever, and the timing doesn't work, right? So that robotic van essentially that's dropping in front of your house can't drop a pizza anywhere else, and so there's no scale kind of advantage to those cars. And so what we've seen over the last week is that Zoom Pizza has shed 80% of its workforce. And it looks like it's going all the way down. According to some of the stories that we've seen, they're going to focus on sustainable pizza boxes.
Sustainable packaging, yeah.
Sustainable packaging, which from robotic automated pizza delivery cars, like this is like a William Gibson like sequel. Like you're going from like a beautiful like sci-fi world to like, it's like San Francisco 2020. People drink oat milk and they get sustainable pizza boxes. So that's where we are.
I can't dispute any of that. I'll just say that I had a different reaction when I heard this news. My first thought was, well, there goes $375 million, because it struck me as one of those ideas that you could talk yourself into, but wasn't inherently a good idea by itself. To be clear, I want to make a point that I wrote this week, but I think it matters. When we talk about layoffs, we are not happy. Like, these are not stories that we're excited to bring up. We often cover big rounds that involve hiring, but when we talk about layoffs, they matter for context setting, but we're not cheering, we're not gloating, we're not kicking dirt on people. No one should get laid off. It's hard on families, people lose insurance, it's bad in general. So don't take any of what follows as in poor taste. It's not, we don't like it. But that said, let's talk about some more layoffs, because there's been a number of layoffs at kind of vision fund companies in the last 12 months. And I had lost track of it kind of in the news cycle. And so some notes about some stuff. There were like several rounds of layoffs at WAG last year. There was layoffs at Uber before that IPO. WeWork fell apart, and then that company went through, an enormous period of laying people off. There have been layoffs at Fair. There were layoffs at Katera, though it turns out they kind of opened a different factory. So it's not clear if that was really kind of the same sort of layoffs. The OneConnect IPO didn't go as well as people had hoped. SoftBank gave up on WAG. Brandless's revenue fell by half. Dara Khosrowshahi had Uber, is getting some negative stuff written about him. And we're not really sure if the Vision Fund 2 is coming. So the summary of this is, it's not just Zoom Pizza. There's some turbulence over at the Vision Fund and a lot of success. So it's kind of that, which is kind of leading. The news cycle points out the negative, Danny. But I'm curious from your prior VC experience, if you think their portfolio in aggregate is struggling, or we're just seeing kind of these negative highlights.
I think there's always a J curve. I wrote a piece a couple months ago about this, and I still believe this, which is in all venture firms, there's a J curve, which is your worst bets lose first. And so all venture funds in the early years always look like they're in deficit. It's always terrible. Everything that's going to fail fails early. Everything that's good is actually going to be there a long, long period of time, right? So the bad stuff is coming through. The mistake here was assuming that a very late stage fund like Vision Fund was not going to have a J curve. Right, they're all 2 years from IPO, and so everything's just going to grow and go public in 2 years, 3 years, or whatever. And I think what we're seeing is there's still really a J curve. I mean, a bunch of these are failures. Some of them are self-induced. Clearly, they were overgrowth. They spent too much money on bad marketing, maybe too many hires too quickly. In some cases, it might be a thesis like Zoom Pizza. Again, I'm not an expert on the pizza space, but it seems like a tough market ultimately in the end, even if at a high level it kind of made sense. Lime is a great example of this, right? I don't know if scooters are going to do well or not, but like clearly it was not ready for prime time. And so to my mind, there is a J curve. The question is are the remaining portfolio companies in the Vision Fund still relevant? They do have a lot of good stuff in the portfolio. Some of the stuff is doing super well. So it's going to be hard to know. The problem is the whole model is sort of predicated on the Vision Fund 2. And you sort of burnt $100 billion somehow in 24 months. And unfortunately,
not entirely.
Not entirely. There's still some left over, right? But you sort of went through the investable capital, and now you follow on reserves. And so the challenge is like, everyone's going to wait. All your LPs, they're going to look at the results and go, wow, it's a bloodbath. Let's just wait around the corner. So I think it's not going to be hard times. I mean, I wish I was running a $100 billion venture fund and I just got to write $5 billion a month. That's not a bad gig. I'll take it. But the thing that actually worries me the most about the Vision Fund was actually the story, I believe it was from Dan Primack at Axios, which was about how the Vision Fund apparently in the last couple of weeks or months has been reneging term sheets, which means that they extended a term sheet to a startup, signed, had an exclusivity to close a round, and then didn't close in the end, maybe because of the WeWork debacle or Uber debacle or any of the number of other debacles.
Yeah. So for people who haven't raised a venture round and might be looking into this as a future activity, the pre-founders that are on the show right now listening, how bad is this, and how rare is it to quote break a term sheet?
It's rare. It's not impossibly uncommon. It's rare in the sense that maybe 2 out of 50 or 60 rounds will ever have something like this happen. So 1 out of 30. I'll do my fractions properly on this show. And it usually happens because of fraud. Frankly, like in many cases, maybe you're investing at the late stage, you're waiting for a quarter's financials to close, and they're half of what you expect. And you thought it was going to be 100 million in revenue, and it's 60, and it whiffs. Right. And that happens. And you're like, no, you made a promise. It was going to be 100 million. Now it's 60. That's not the same company. And at that point, you're sort of in a really bad spot. It's unusual because as soon as you start to do this and it starts to become widely known that you do this, it's sort of like when your handshake is no longer valuable. Right. You do a handshake deal. But if the handshake's not worth anything, then how do you actually get exclusivity and actually close a round? And so I think, maybe they benefited from it. Maybe they're having challenges on cash flow. I mean, there might be all kinds of other reasons why it's happening. But if it really becomes widely known that they're going to break their own term sheets, why would you ever take it in the first place? And that's really going to harm, if there is a Vision Fund too, that kind of reputation is really, really damaging.
Yeah, and then one thing that I saw, and I don't know how important this is, but you might have a better view on this, given that you've worked for 2 different VC firms, is that there were tweets about this. People were saying, shame on SoftBank, how dare they, don't trust them. And it felt like a lot of grumblings that had been beneath the surface kind of broke out, as if people were no longer afraid of pissing off SoftBank. And as they had been, for, as you and I both know, for a long time, because they didn't want to say the wrong thing and then have one of the portfolio companies, be like raised against by the Vision Fund. As the fear climate changed, given that the Vision Fund 2 is still somewhere lurking and not quite here yet.
I wouldn't even call it fear. It's a lack of opportunity, right? SoftBank's not going to write $400 million checks in the next year, right? They're probably not going to write all that many checks at all for at least a year or two. So as with all things tweets, they go out now, no one will care in a year or two. So there's a little bit more freedom than you had before. Unless
you're going to host an award show and then delete that shit.
Right. Exactly.
So let's talk about GrubHub for a minute. Now, GrubHub isn't normally a company inside of our domain. This show tries to focus on startups from the early to the late stage and then kind of the IPO cycle, and that's it. GrubHub has been public for a while. Why do we care what's going on? Well, they had a really terrible Q3 going back in time, and they kind of subtweeted DoorDash and some other companies in the space. And then time passed and their stock went down. And then the stock went back up because the rumor on the street, the reports are that they are exploring strategic options, which means they're willing to sell. And people like that because it tends to mean a premium. So now they're back to the $55 per share range. Okay. Now, this matters because there's a bunch of VC bets in the on-demand space. We got DoorDash, Uber Eats is now public, but you know what I mean. Postmates is somewhere stuck between an IPO and an exit. And there's a lot of money bouncing around this space. And if GrubHub can sell, it'll set a price for what these companies are worth when they're profitable, as GrubHub tends to be. And also it could lead to consolidation, which could limit competitive pressures, which could kind of let everyone have a bit more margin, provided that the market will allow that. So I just wanted to kind of name check this really quick and let everyone know that it's something to keep an eye on if you're tracking the on-demand market in general. If GrubHub fails to find a buyer at a price that it likes, its stock will probably go back down, and that will hurt all players in the space. But I don't have an acquirer in mind. I don't know who might. It's not going to be Amazon, right? I mean, so then who the hell is going to buy GrubHub? It's not Uber, so I don't know who does. But it's going to be curious to see if anyone takes a nibble or a bite, and then if some investors who are pushing from behind the scenes, we think Caledonia might be doing that, are satiated with their demands. Danny, anything you want to add to that? I tried to do kind of a summary.
No, I think that's great. I think, here's a stock that's lost 2/3 of its value over the last 18 months, right? So it peaked about July, August last year. at 146 or so dollars a share. It's down to what, 56 now. So it's lost an enormous amount of value, and most of that, from what I can tell, is really the multiple. I mean, it just has had huge multiple compression, right? So I don't think its revenues, as far as I know, have like cratered in the last year and a half. It's just expectations. So right now, according to Yahoo Finance, the forward PE ratio for the company is 253. And that's sort of the problem with the on-demand space is it's always about this potential, right? It's this growth, it's this future, and it's similar in Uber's case as well. We're seeing the same thing where, profitability was next year, now it's 2 years, now it's 3 years. Every year we go forward, it's another extra year ahead. And I think we're at 2023 was the last number we heard?
Yes, but at least they have a forward PE ratio.
They
Uber
have a forward. Exactly. Right. It helps to have at least something at the bottom line to keep the propel the company forward. And so that's the question. I think the challenge. I think you're going to see consolidation. The nice thing, the market cap of the company is $5 billion right now on the public markets. That's actually a price that a lot of people can kind of swallow. Google can swallow that. Amazon can swallow that. Like a bunch of people can swallow that. And so the question is the brand name, the marketing channel work, the installed customer base, does that all make sense? Or is it like, hey, we're just going to cannibalize it. We can buy those customers for less money on a marketing channel. Consolidation is going to help us. So I don't see them merging, but we'll know probably pretty soon because they are going through these strategic options.
What about, and I just came up with this, and it may be very, very dumb. You can laugh at me if it's not good because it's not something that I wrote down. What about Yelp plus GrubHub as one public company?
I mean, to me, that seems like the obvious choice. My guess is that they actually had that conversation, and that's why they're talking about strategic options, is actually to push on that harder, right? You announce, we're considering alternatives, because you have actually someone in mind. You're trying to push them, and they're like, no, we don't like the price or whatever. And so, again, at $5 billion, you can even imagine a take private kind of opportunity. Maybe someone comes in and says, hey, we're going to go directly compete. And someone like Yelp goes, actually, we'll pay more to avoid having someone dump another $5 billion into this market of primary capital for GrubHub, right? So to me, anytime you're announcing this, sometimes when you do the S1 for enterprise companies, it's the same thing. You're just putting the numbers out there, so it starts a feeding frenzy.
You're dual tracking, as it's called.
That's right. Except in those cases, you actually have real revenues, oftentimes like a really, really nice model. It's a huge growth story, and a lot of big enterprise companies want that. GrubHub is a much tougher story, right? It just it exists, doesn't make a huge amount of money. It is growing. It's not growing really fast. The multiples are compressing. It's not a happy story.
No. And if you want to go back in time and look at two examples of what Danny's talking about on the enterprise side, AppDynamics and Qualtrics are two companies that almost got public, and they looked fantastic. Like they're just some of the strongest companies that would have gone public in their cycles. And instead, they were snapped up for bajillions of dollars by large companies who were like, oh, that's gorgeous. We'll take that because we'll take the revenue growth and the limited losses. So it was just kind of a hot situation for both. Cool. Oh, gosh, this is just a sad episode. We just have more bad news to go over.
But it's not food. Well, there will be drinks, but this one's not about food for once.
It's true. This one's about China. And for anyone who's listened to the show for a long time, there was this period of time on equity when like every bit of news was about China, like taking over everything. China raised the most rounds. They had the most unicorns. They were building the most new companies. And that's all gone away if you've been listening. And it's not because we decided to ignore China. It's because they're undergoing an enormous cratering of their venture capital dollar volume or equivalent to dollar volume. I wrote about this, I think last October and November, about how their share of supergiant rounds, which are 100 million or larger, had just collapsed over a multi-quarter basis. And the Financial Times, a paper that I read almost every morning in print, had a great story that says China tech startups go bust in 2019 capital winter. And that's kind of a good summary. There's been an enormous amount of startup deaths over there. For example, a data provider noted that there were 336 startups in the country that were forced to cease operations over the course of, quote, last year. And here's the kicker. They had raised $2.5 billion between them. So an enormous amount of money had gone into these hundreds of companies that died, and then they died anyways. And I have one anecdote, and then I want to hear from you because you've been in Asia way more than I have. There was a startup called Tao Gigi, for lack of a better shot there, and they're going into bankruptcy. But what's crazy is they had over 130 million people that used their service, and they had raised $42 million. But somehow they were $230 million in debt to their suppliers. So like sometimes I think we conflate scale with success. And as we can see from that, it's not the case. But these are not just small deaths of local YC graduates. These are often big companies. So with that, Danny, I want your impressions on this.
No, I think, 2 years ago, we were talking about nothing but China, hundreds of unicorns. And I think we're going to actually talk about the bubble a little bit in Silicon Valley next, but I think the bubble absolutely did pop in China. Everything was overvalued. Many of these companies were mirages, marketing machines that were subsidizing, 7 to 1, 10 to 1 dollars or yuan, if you will, into these companies. And so if you give people free $10 to make $1 in revenue, well, I mean, you can get growth unbelievably fast. You're just literally throwing money around. But what's happening now is people are realizing that many of these business models have nothing behind them. They're literally paper tigers, to maybe borrow a phrase. So I think what we're going to see here is something really challenging, both because the Chinese government really wants the startup sector to succeed, is putting a huge amount of money in, just as the trade war sort of kind of intensifying, not intensifying, and so all that comes together, and it's not going to be a pleasant place for startups. That said, there is one caffeinated version to continue our food and drink theme today, which is Luckin, which we've talked on the show. Hell, I've talked about it. I've talked about it 7 times on this show. Luckin Coffee was like the fastest growing coffee chain probably in world history. And so last year, it actually surpassed Starbucks as the largest coffee chain, mostly through vending machines and sort of in China. Exclusively in China. No, as far as I know, international operations. And so they announced earlier this week that they're going to launch even more vending machines all across the country, and are also going to raise another $800 million. Yesterday or 2 days ago, when the show is actually launched, the stock was up 12% on the public markets. And so there is it's interesting because we used to joke about this because it was so ridiculous. It was like every month it like quadrupled in size. But we're actually, even with the compression of every other startup in China and Beijing, somehow Luckin is still doing well. So maybe there's something lucky about Luckin.
I mean, 1, that was a beautiful turn of phrase. 2, I just grabbed some numbers. I think it went public at $17 a share in the US, right? Have you looked up its stock price? Have you seen this before?
I have not.
All right. Now I want you to guess how many dollars per share is Luckin worth as of the end of trading today.
I'm going to say 35.
Wow, you're actually low. It's 44.37.
There you go.
According at the end of trading on Thursday.
So two and a half,
the reason why that matters is it shows that not every company that blitz scales dies. Some of them pull it off, and it just seems to be kind of the anomaly that it works. I think it's what we've learned in the last 18 months.
That's right. And look, part of the magic here is, again, it's vending machines. So the cost structure, unlike Zoomy or Zoom Pizza, where the van, I like to call it Zoomé, because I always felt it was like French. It was a little bit more sophisticated pizza than like Domino's or something like that. So it's Zoomé. But Zoom's vans were extraordinarily expensive. I mean, robotic pizza vans driving around self-driving is totally different than a vending machine that pours out coffee from a button. So I think the cost structure makes a lot more sense here. And obviously it's continuing to grow. So
yeah. Yeah, I mean, I now really want to try Luckin Coffee, and so what they should do is they should open up their very first ever international branch right here in Providence, and I'll be the first customer. But people who don't know this should realize that most of their stores are delivery only, and they're not places where you can go. So they're not like Starbucks. So we say it's taking over Starbucks in terms of locations, but mostly it's around delivery and vending machines, which have a lower cost structure to some degree. I mean, the economics somehow work out. It's amazing.
Well, my understanding is it's heavily focused on office workers, and it's heavily focused on group purchases. And so it's not like a cup of coffee is being delivered, or like in the Bay Area, you can now use Jupiter, and you can have people deliver milk right into your fridge exactly on the shelf that you want it by pinpointing on the picture exactly where in the fridge you would like your milk to be placed. In this context, in some cases, it might be like 50 cups of coffee are delivered to the same office in one go. It's just a totally different scale.
All right. Well, before we go on to the Sam Altman bet that Danielle Morrill covered, I just want to point out that if you're an adult, buy your own damn milk. Try it. It's fun. You go to the store, you can pick which one you want. You don't have to worry about someone bringing you the wrong one.
Do they have multiple milks in Providence?
Shut up.
Like soy, like oat, almond, or macadamia?
There's 2 Whole Foods in Providence, sir. 2. I have you know. Anyways, enough of that rudeness. Go to your own grocery shopping, and let's talk about Sam Altman. Now, Sam doesn't come up as much as he used to. He's no longer in charge of YC in the same capacity that he was. We actually interviewed the current head of YC, Michael Seibel. There you go. But back in 2015, he made a bet, a 3-part bet, Danny, and the wager was against there being a bubble, in a sense. He said that the companies that were then accreting a lot of value, we're going to keep doing that. And what's kind of fun is 2 of his 3 bets worked out. So I'll tell you what, I'll take 1, and then you take 2, and we'll split 3. Fair enough?
Sounds good.
All right. So Proposition 1, I'm just going to read this for everybody. So this is my reading voice. On January 1st, 2020, the top 6 U.S. companies, Uber, Palantir, Airbnb, Dropbox, Pinterest, and SpaceX, will be worth at least $200 billion in aggregate from just $100 billion in 2015. Now, turns out not true. They're worth between 30 and 40 billion less, depending on how you do the math. But they did add 70% of their value, or 70% more value over the last 5 years, give or take. So my read of this is that Dropbox, let's just go through the list. Uber grew and then struggled, as we all know, in the last 2 years. Palantir can't go public because no one knows if it's a service business or a software company. Airbnb won't go public because it doesn't want to, because it's being a brat. And now it's to direct list because it's too hard to price, like every other company in the history of IPOs. Dropbox is only worth $7.5 billion, turns out. Pinterest has done well and not well as a public company, and SpaceX is kicking ass. But they're worth a lot of money. I mean, these are big companies that have material revenues, serious market growth, and so forth. So a miss there. And let's go into Proposition 2.
Well, I was going to say, I think on the first one here, I mean, there's a little bit of a power law, right? What's interesting here is I think there was an expectation that one of these 6 was going to be, a $200, $300, $400 billion company like Facebook, Google, Apple, Microsoft, the FANG companies. And ironically, none of them did. I mean, Uber was probably the closest at one point when it was hitting its peak at 100 at one point. But I think we now know that that's really not coming together. And clearly the others are definitely not on that course. At all. So there's really no kind of power law distribution there. They're all sort of, Uber's the kind of big winner and followed by Palantir, but they didn't really add up in the same way that we might have expected. But let's go to Proposition 2. So Proposition 2 is my reading voice, and I have to be careful using the word proposition in California because that's a bad word these days in San Francisco politics. But Proposition 2 says on January 1st, 2020, Stripe, Zenefits, Instacart, Mixpanel, Teespring, Optimizely, Coinbase, Docker, and Weebly, wow, that's a lot, will be worth at least $27 billion in aggregate from just under $9 billion in 2015. And that ended up being true. Actually, unlike in Proposition 1, in Proposition 2, we do have a sort of a power law because Stripe itself is worth $35 billion, which is more than the Proposition's $27 billion estimate. And obviously Zenefits didn't do all that well, but Instacart's out there, Teespring, Optimizely, Coinbase is still a huge company. Docker kind of had its own issues. It's actually kind of funny how none of the others come to mind as like really strong. As I'm going through this, I'm like, actually, reverse course. That was a bad idea. But Stripe itself, boom, 35 billion, and it looks like it's on course to continue to do well. And so Sam Altman got that one right.
Okay, so let's talk about these though, because Stripe, to the best of our knowledge, has put together a very large business. Does done quite well. It's raised a bunch of money. People in the investing world love it. I don't have any information that I can cite to the contrary, so I guess I'll give that a pass. Zenefits, we all know what happened there. Whoops. Instacart has gone through some pricing issues, some tipping issues, some labor issues. I'm kind of actually old friends with one of the co-founders, ironically. I haven't talked to him in ages. I don't know how they're doing, but they're worth several billion. Mixpanel was huge and then slowed down. Teespring imploded. Optimizely, I don't know. Coinbase has done tremendously well. They're the blue chip blockchain crypto company in the US, if not the world, aside from Bitmain. And their leadership is super sober. And I only had nice things to say about them and what they've done through the crypto winter, honestly, which I know is for me a little positive. But Docker struggled. And Weebly, I think, is doing good, but I haven't heard recently. So
I haven't heard anything about Weebly in years.
Yeah, it's more of a mixed bag than I think, but your power law comes in and it works out. So take us through Prop 3, if you will, Mr. San Francisco voting.
Yes, so in Proposition 3 from Sam Altman, the current YC Winter 2015 batch, that's one of these predictions were made 5 years ago, will currently worth something that rounds down to zero, will be worth at least $3 billion on January 1st, 2020. And according to Danielle Morel's estimate, that is true. GitLab itself is worth $2.75 billion private valuation. Razorpay is worth $450 million. Atomwise is worth $150 million. And Chariot was required for $65 million. And that all adds up to more than $3 billion. And so even though a lot of that is not realized, obviously, it seems that at least on the private markets, that 5 years out, that YC batch was worth several billion bucks.
Okay, so quickly, I realized we hadn't introduced Danielle. Danielle is the former CEO of Mattermark. She is now building something actually over at GitLab, interestingly enough. And she's actually my former boss and is a person to whom I have a great personal debt. So shout out to her because she's fantastic and is just a really cool human. A caveat though about GitLab and the valuation that you just cited, because we happen to know how large it is, which lets us kind of put that into perspective. So I talked to the CEO of GitLab weeks ago, 3, 4, whatever it was. And they said they were going to hit the 100 million ARR threshold in January of 2020, which is now. So presuming that everything went well, because they were super close to it when they told me in December they were going to hit it in January, you can kind of forecast a month out. They're worth, 28x ARR, which is a lot. So sure, yes, currently these companies are valued at more than 3 billion, but there is a lot of optimism in those numbers, and GitLab has a lot of growing to do to grow into a 2.75 pre or post money valuation. So 2 out of the 3 for Mr. Altman, and not the way I think we would have guessed this would have gone out. I would have bet way more on Uber being successful than Stripe. But, again, proves why
and
I'm
I think that's the question with a lot of these power laws, right? It's so sensitive to that one company. I mean, what's interesting about Proposition 3 is GitLab is the return right now on that. That batch probably had a couple dozen companies. I don't think it was expanded to YC scale where it's 200 now, but it was at least a couple dozen companies back then.
Yes.
And one of those companies represents 90% of the value, at least according to this estimate. And so, from my perspective, it's like it's a lot riding on GitLab to actually deliver on the winter 2015 batch for YC. And that's just a reminder of how sensitive a lot of these returns are. Uber, if it was 100 billion, we would actually have hit Proposition 1, exactly. Which it was worth 2 years ago. And that's how fast these things can change.
One last little caveat, though, on GitLab, because I just remembered something. They have a planned IPO, and this is off my top of my head. I think it's like November of this year. So, we should be able to see GitLab become a realized value point, which is actually to Sam's credit, because if it holds up that valuation by then at 140, 150 million ARR, whatever it'll be at that point, it might pull it off. It's still rich multiple, but if the market will take it, it will. So, anyways, a fun bet to keep in mind that 5 years is a long time, but 2 out of 3 from that distance, not bad. Certainly better than equity has done over a short time frame. This show is not good at predictions.
Kay leaves for 1 week, and you already are. Never mind.
Look. We all know that we're good at making lame jokes. We're not good at making predictions. One tiny thing, and then we got to go. Had you heard of Sisense until recently?
I have not.
Okay, so Sisense works in the BI space. They bought Periscope last year. They were part of this $100 million series that I've been writing, 100 million ARR series. They raised 100 million today, or announced it today, and now they're a unicorn. I just want to throw that out because I just talked to the CEO like an hour ago. So if you want to look at the currently the world's newest unicorn, Sisense, it's on tc.com. Take a peek. But that's it, man. That's all the time we have.